Good afternoon, everyone. Welcome to this TradeStation webinar. This is Options Replay, Strategizing Your Options Trades. It's a type of webinar where we look at different trades opportunities that have happened recently and talk about the setups, the reasons why the trade is executed, and why the trade worked or didn't work. So it's more of a presentation on the practical side of options. And today, so the guest speaker is Brandon Wendell, as we usually have him in our presentation. Thank you, Brandon, for being here. My name is Jesus Nava. For those that don't know me, I'm the Director of Client Training and Education for TradeStation Securities. It's always great to talk about TradeStation and show you some tips and tricks that you can utilize on your everyday trading. Let me go ahead and go through some of the disclosures before we get started today. Keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, active trading is not suitable for everyone. It's risky, and we should all be aware of the risks, especially when trading options, which carry a high degree of risk. And also, past historical performance is no guarantee of future results. If something worked in history or in the past, it doesn't mean that it's going to do the same thing in the future. For additional information on these disclosures, go to www.tradestation.com/important-information. And it's important to note that Brandon Wendell, even though he's a guest in today's webinar, he's not affiliated with TradeStation, but he is a great educator, a great trader, and it's great to have him here to speak about some of the trade setups that he's thought of or placed in the past week. Before I pass the microphone over to Trent, I'm not to Trent, I'm sorry. Before I pass the microphone over to Brandon, let me go ahead and show you where these presentations are being recorded, because as every other presentation in TradeStation, this one is recorded and you can access it. Let me go ahead and pull up my TradeStation website right here on this screen. So this is tradestation.com, hover over Learn, and then go to Options Education. When you land in the Options Education Center, which I do encourage everyone to come here and explore all the different articles and the webinars that we've done. But if you scroll a little bit on this page, you'll find a banner that is titled Options Replay. Here, you can register. Most of you, all of you have registered because you're here inside the room, but you can watch previous presentations. So this one is being recorded and it'll be posted here. The big box right here in the middle is the most recent Options Replay. But if you scroll down, you'll see past Options Replay presentations, and we title them based on the topic that was covered. So you have an idea of what type of strategies are presented and use it, if that's the type of strategy that you want to learn on. Okay, great. All right, that's my introduction and my disclosure. So let's go ahead and pass the microphone over to Brandon. Brandon, are you here?
Sorry about that. Yes, I am.
There we go. I was gonna let me check. Where is he? All right, Brandon. I'm just gonna mute my microphone and my camera, and it's all yours. Thank you for being here, Brandon.
All right, thank you. And yeah, we'll go ahead and kick this off. Actually, I want to welcome everybody here. And actually, I was got a question for Jesus. I was doing the search to see an options trade that finished, and for some reason, I don't see the results here for the one that expired. Now, I didn't close the position, so I'm not sure if that was the issue, but it basically expired in the money. The one did
Yeah, I
on
think
the
that's an
Hershey
issue
straddle.
because the trade manager analysis doesn't see the expired contract as a closing transaction, so it doesn't pull it up in the trade manager analysis.
Got it. Okay, that's what I was figuring. So no big deal. But oh, thank you, Chris. Yeah, fly Eagles, fly, go birds. I couldn't resist, so I put that on today. Anyway, I got some screenshots, so we're all good anyway. But last time we were together, first of all, I should introduce myself. Brandon Wendell, as Jesus mentioned, I've been trading in the markets for almost, gosh, close to 30 years. Yeah, I've just been focusing primarily on futures and options, and futures options, as a matter of fact, kind of a mix of both, if you will. And I've been invited over here today to speak with you guys on a regular basis about options trading in TradeStation. And when we were together last time, we were talking about doing some options for earnings because we're in the middle of earnings season. Now, I caution you, don't go out there running to see what's releasing earnings in the next day or so and try these types of straddles and things I was using, because you need to do them before the volatility goes up. Remember, we were talking about Hershey. As a matter of fact, what was I going to look for here? Oh, I was going to bring open a new workspace. And these workspaces are available in the Options Education Center for download, of course. And yeah, we can talk a little bit about the trade manager analysis if you got some questions. I was going to kind of walk through some of the trades as well, but I was going to look for, let's see, where is it here? Straddles for earnings, which I had open prior with you guys. There we go. It just takes a moment to open. And I actually have a bunch of different computers running on, this is just one computer of many in my house right now. So I apologize, this is running a little bit slow. Anyway, so this is, again, the workspace called Straddles for Earnings that I had shown you before. It's available in the Options Education Center. All the tools are there. And out of this, picked out Hershey's, and this was a while ago. The actual entry for the position, if I go back over here in my Trade Manager window, and I'll go ahead and enlarge that one. We did 3 different opportunities. As you can see, there was straddle, straddle, straddle. These were all put in on the same day, which was the 10th, about a month ago, exactly, on Hershey, because they were going to release earnings. And I believe the earnings came out, I think it was on Friday or Thursday of last week. Might have been Thursday the 6th, I believe. And you can see I had various filled prices. And the reason why I did this was I also chose the same strikes with different expiration dates. And the expiration dates, the way this is showing for you, if you're not familiar, is the year, then the month in 2 digits, and then the day in 2 digits for expiration. So we have 25/02/07, so that's the 7th. Basically, that was the day after the earnings release. Those options expire on Friday, the 7th of February. Then we have 14th of February. These ones expire this week. We have, well, I went out to May 16th. And again, it's just the straddle that I put on, because obviously with earnings, we don't know what's going to happen. If there's going to be positive earnings, there's going to be negative earnings. We don't know what the heck is going to happen. You can see there definitely was a reaction. And this is pretty typical. If we go back to the day that I was planning this trade with you guys, and let's see, we'll go to drawing here, bring in a vertical line on January 10th. If I can catch it right about there. Yeah, 110 is perfect. On that day, we were trading right around $160, right near the close. And obviously, as you can see, the earnings came out, and this is on the 5th going into the 6th. So there was a big jump after hours after the earnings were released. But more importantly, take a look at what was going on here with the volatility, because again, with the options, the volatility is a lot more important than many of the other factors that we look at, such as directional movement in the options. Not necessarily, we don't want to only look at volatility. We want to look at everything together. But for the most part, the volatility can have a big impact, a much bigger impact on the option pricing than you can get on the other the Greeks, such as the time decay and the delta, the directional. So again, right here, when we were putting on the trade on the 10th, we were pretty much trading with the volatility right at the average. And as you can see, if I zoom back out, nope, wrong way, zoom out, what happened? Volatility went up, went down, went way up. So we had a jump in volatility. Originally, we were sitting somewhere around, 26, went all the way up to about 42. So big jump in volatility. And then look at where it ended up after the earnings, right back down. Now, if I take a look at the open positions currently, which I should have open, you can see that those are both in negatives right now. And the reason why they're negatives, obviously, the prices have gone right back pretty much to where the strikes are. So we're not making anything on the delta, and the volatility has collapsed back down much lower than where I first entered. So I kind of missed the opportunity to get out. But if I go back to a picture that I have here, on the 7th, or sorry, the ones that expire on February 7th, the short-term options had a very little profit. However, take a look at which one had the most profit here, May 2025. As a matter of fact, the 14th, they were negative on the same day. All of this was done on the exact same day. So what's the big difference between all these? Well, it's actually the exposure to volatility. It's really what it comes down to. You're going to have, with different options, the closer you get to expiration, the less effect that volatility might have on price, because even if volatility goes up, there's only so far prices can move. But if volatility rises, When you have a lot of time left until expiration, then obviously prices can make a big jump. So that's why this went up. It had more exposure to Vega. Take a look at the Vega here for the positions: 59.39, 11.69, and 5.92. Big difference, right? So we had huge volatility exposure, well, very little, and almost none at this point because this one was getting ready to expire. Time decay is just the opposite. Time is not really a factor here. And that's the reason why I really lean more on that long term option. I figured this one was going to give us the best return anyway for that opportunity because it has very little time exposure, which means if I close this out now, well, it's obviously a little late to get out now because it's gone negative quite a bit. No, not quite a bit, actually. You can still see $180 in out downside. Meanwhile, the February 14th next week has almost over $700 of loss. And again, the reason is that volatility exposure and now time decay. Look what's happening every day that we go by: $47 of loss on the options that expire next week, with only $9 of loss on the long-term options. So when I'm going out to analyze and choose these opportunities, yes, the long-term options cost more to enter, but you can definitely see the reason why you want to do that. There's better rewards. And in this case, I apologize, I can't seem to get that picture right now, but if you had exited the day before the earnings when we were trading at about $141, or even before that, right around 146, again, the delta wasn't going to give you that much of a difference here. Okay, you're only talking about maybe $4 of price movement. And let's see what the delta was in the picture. Yeah, there's where I took the picture on the third and the fourth and fifth, right in that area. The delta on this option, 70. Okay. And 77, only 24 for the long term. So that wasn't going to change a whole lot, but the volatility jump was much greater. We had what, a move even in that small time frame. We go back here. This is on, oh, there are we here. There's the third. Look at this difference in volatility. We were spiking in volatility right there at about 42 on the third and the fourth, and then collapsed. That dropped in volatility from 42, almost 20 points, 18 points to the downside to 24. So you lost, hang on before I move anywhere. You lost 18 points of volatility while you only lost about 6 points in price. Delta 24, Vega 59, right? So if I do this calculation, bring up a calculator here for us. So again, we dropped in value $6 times 24.16. That's 144.96 in loss from the dropping in price. However, volatility was a little bit more of a change, wasn't it? So the profit potential is much, much bigger when it comes to the volatility than it does with the delta, the directional movement. Same thing here on that longer term option, well, shorter term option, excuse me. On the shorter term option, the delta for that straddle that was on the 14th, 70.93. Again, we only moved about $6, $425 of price movement. However, the straddle, where's the Vega? There it is, 1169. Yeah, we had $210 of volatility movement, not as much as the $1,000 we had here. So obviously there's a big difference between those. And that's why when I'm going long on options, typically I want to go long on options that have a much further expiration. So that way I'm kind of taking the theta out of the equation. It's still going to hurt a little bit as time goes by. There's nothing you can do about that. Time passes no matter what. And the value of those options will automatically drop as time decays. But what I'm trying to play is not just a big move in price. As a matter of fact, it really didn't matter if the price moved a whole lot. And from the entry around 160, yeah, we did drop about, what was that, $12? in price, but the real gain was this move up of almost 20 points in volatility. And that's what happens with these earnings. And you can see right as the earning release comes out, actually just a day or two before, look at the collapse in volatility. And that's a normal thing. That's why I looked at Hershey in particular, and we took a look at this again. I don't know if you recall, but you can go back and take a look at those previous sessions we had. But whenever there's earnings releases, typically, there we go. And oh, I don't have that on this chart. Hang on, I have it over here. Believe, yeah, there's the indicator. Why not calendarize or diagonalize the long units? Well, I could, but the reason why I was doing it as a straddle is I don't know which direction the price is going to go, and I'm just trying to capture the volatility going up and neutralize everything else. By going long a call and a put, I have delta neutrality for the most part. Again, going back, this is not showing the entry for the position, but if we were to take a look at a position currently, again, it doesn't have to be Hershey, it could be any security, but again, I was focusing on what was already done in the past there. Yeah, you could do a lot of different things. There's plenty of different strategies. I'm just trying to keep it relatively simple. So if I were to go out once again, longer term, I want to have at least 30 days left at the earnings release. And typically I might even exit before the earnings release because I don't have to worry about the price movement. As long as we get a big move, it's great. If we don't, I just need that big move in volatility. And that's really what we're playing there. So again, if I do this where I go, let's say long on the 140, oops, put and long on the 140 call, if it lets me, there we go. There we are. Oh, is that right? Yeah, there it is. So a long call, long put, and the delta, not necessarily neutral. I don't know if this is priced correctly after hours here, or 150. Oh, no, that's why I'm way out of the money there. Chose the wrong one. Sorry. Got the sun coming in on my screen here. It makes it harder to see. Anyway, we're at 154 right now. So I would do the 155, not 140. So I want to do at the money options. There we go. That's a little bit better. And my delta is almost neutral. If I can get it anywhere between -10 and +10, what I've done there is I've neutralized my delta because it doesn't matter which direction prices move. Because I selected options that don't expire for quite some time, in this case, 95 days, I can go further. I'm neutralizing a lot of the theta as well. So my theta decay is very, very limited versus doing a short-term option. And of course, my volatility exposure, we have 31 plus 31. So, it doesn't, I don't think I have that as a column here. And can I add that or no? Actually, not on this part. It's on the analyze. So we go over there and make sure not everything else showing. I do. There we go. Feb. Come on, get rid of that. There we go. That's better. Just the one. So again, there we go. Now we got the Vega is 62.39. So once again, the reason why I do spreads in general, it doesn't matter if it's a simple spread to take care of or take advantage of a price move to the upside where I could do a bull call spread or a bull put spread, or I could do, the simple verticals. Or if I'm doing something like this, where I'm trying to take advantage of a big price move due to earnings, or more importantly, a big volatility move due to earnings, I'm basically trying to isolate the one Greek and neutralize the others. That's risk management. That's all it is. These Greeks are managements of risk or indicators of risk in that position. The closer you get them to zero, the less they affect your position. So getting my theta down at 9, I'm under 10. Okay. Delta is almost at 10, 10.05, very close. And my Vega is very, very high. That means I have high volatility exposure. If I change the dates on these, I'll go to a closer date, Feb 28. There we go. And look what happens. Okay, my delta is still pretty neutral, right? 0.25. It's almost zero, no big deal. My Vega, though, is only 27. I lost a lot of that volatility exposure, which would help me because we know as the unknown approaches, volatility goes up. That's unknown of the earnings release. And here's the other exposure I increased, my time decay. I went from 9 to 19.55. So that's the big difference. A lot of people try to buy cheap options, meaning they don't want to spend a lot on premium, so they buy options that expire sooner rather than later. The problem is you pay for it in the end. Even though you're not putting out as much cash down, you're not managing your risk properly. There's risk from a lot of different places, and it's all measured right there in your Greeks. The delta, vega, theta, and gamma, and rho, depending on what Jerome Powell chooses to do. But yeah, there are other alternatives, but I was trying to keep it simple. And with the strategies that we have available in the Options Education Center, this is one that you can get more information on, as I said before. And yes, I can go into, oops, place right there it is. Where was I here? Looking for Hershey. It's all about finding that pattern that repeats itself. And you can see wherever there's an earnings release, there's the EPS numbers in the orange right there when they get released. The pattern's pretty typical. Implied volatility, relatively low about a month before, incredibly high just before the earnings. Relatively low. Where is it here? There it is. Yeah, relatively, I said. It's still pretty high here, but it went higher. Our most recent one, big jump. Okay. And before that, and that's why I selected this one in particular. But we can look at almost any security that comes up on our list and look for that pattern. So right now, I think we're a little too close to the earnings, so nothing's showing up, right? All the earnings have either been released or, let me see if I take this off. Less than 35 days. Filter's a little too restrictive still. Yeah, volatility is too high already. So let's see, is anything going to show up? Still nothing, really? Is the filter working? There we go. It may have just taken a moment. Oh, that's why. It got changed by mistake. I said description instead of a value of 10,000. That's what I was missing right there. Okay. And implied volatility should be lower than historic average. There we go. Yeah, see, that's the problem. We've got earnings coming up a little too soon on some of these. Oracle, though, is still decent. Broadcom's off the, kind of too close. But again, looking at these, you want to make sure that there's the pattern that repeats itself. We have Oracle earnings in about 28 days. And that pattern is there, running up into the earnings, running up into the earnings, running up. And we have a high average right now, but we're, believe it or not, slightly below the average, aren't we? Look at that. I probably wouldn't do this one. The overall volatility is too high. So this one is not setting itself up for a good opportunity. But if we can catch, well, I mean, again, volatility is somewhat high. The average is somewhat high, but volatility is below the average and is likely to go up. It was right here too. Going back to November, going into December's earnings, the earnings were released December 10th. And November 10th, about a month before, and we were actually above the average here. And you can see the volatility went from 33 and doubled almost, went up to 60, 59.34. So nearly doubled in volatility. Again, that would have been a great opportunity. Is that likely to happen again? Well, it's happened in the past. No guarantees, of course, but it's likely to happen again in the future. So when you mention calendarize or diagonalize long units, what do you mean? Or do a double? I mean, you could do a calendar spread, yeah. Which again, if you're not familiar with the strategy, under Options Education Center, there are the strategies available out there. And there is a diagonal. But again, that's one direction. Well, I guess again, you get some direction either way, but overall, that wouldn't be the choice that I would do. And that's the nice thing about these risk profiles. You can kind of get an idea of how they might profit based on direction. Let me go back here a little bit more. Where is this? It's actually one of the first ones there, just straddles for earnings. So again, we're likely to see a big move in either direction, but this little triangle, that loss triangle, rises with volatility as well. So if we can catch it with low volatility for the position, it's likely to go up very fast and increase the price. So where was I here? Talking about Hershey. And what happened there? Did that get, oh, it got combined again. That's what happened. I accidentally combined them together. I can split those a little bit later. Any questions so far about the rationale behind doing that kind of a strategy? So again, if we're looking for another opportunity or trying to apply this, we can also get an idea of potentially how much we're going to profit based on the volatility rising. So I don't want to go into any particular security that's, again, releasing earnings and doing any kind of recommendations, because that's not what we're doing here. We're just kind of doing a post-mortem for the most part on the previous opportunities and taking a look at it just in general. So if we were to take a look at a stock that already released, just to be safe here, kind of walk through. Anyway, I just brought up Tesla because it's a very popular common stock. And obviously earnings have already been released. And you can see the pattern is there as well, although not as good as it was on Hershey. You can see we didn't get much price movement in the month prior to the earnings to when the earnings were released. But the big move was, again, in the increase in volatility. And the best time to get out was actually before the earnings were released. Now, if you have earnings getting released shortly, you might be okay with selling high volatility and selling short time, doing the complete opposite. The problem with doing that is if you try to do it as selling a straddle, basically you have to be a level 5 options trader and have a certain amount of experience as well as capital, because you have theoretically unlimited risk when you sell a naked call. Selling a put, you have limit or risk from the strike price down to zero, but when you sell the call, you have unlimited risk. So one of the things we could do to minimize that risk, again, coming up to earnings, because volatility is already very high, if you want to put on the long side, you got to do it well before the earnings release. That's why I have the scanners, and you can go ahead and find those. If you want to do it right before the earnings release, you could use perhaps an iron condor and butterfly, or a condor or butterfly, like that. So once in the trade with the strategy, what do we look for in managing it? Okay, great question. Okay, so let me go back to Hershey's then for that, because that'd probably make more sense. And that's a lot of stuff that you need to figure out before you get into the position. Okay, we can take a look. Obviously, we know now what the volatility movement was and how much prices have changed. They really didn't change much. Again, going back to my other chart that has that label already. There we are. You can see that we were right around 160, we're at 154. So we're only $5 difference from where we were. Volatility went up, came almost right back down. And that happens a lot. That's kind of what I want to look for, something that almost returns right back to where it was after all the excitement is washed away. So what I'm looking for when I go back is, okay, we don't know what's going to happen, but based on what has happened previously, we can get an idea of what to expect, right? And I don't know the study, I have it over here rather than trying to find it, open it. And here's the earnings release. And my drawing bar. Hit the next one. the next one, and so on, if I want to. I'm not going to keep going, but I'll start right here. If we're looking back roughly a month, this is August 2nd. So we're going back to July 2nd. And looking back, this is a pretty good setup right here. Again, Hershey seems to be doing pretty good setup for this altogether. Not only did we have a nice general price move that would help the call in this case, hurts the put, but we gain on the call in delta. But at the same time, we had very low volatility. And definitely below the average. So overall, it's low and below that red line of the average. So that's pretty good. So what am I looking for in this time? Well, if I'm putting on this position, okay, we know what the current implied volatility is. In this case, about 22. I can look back to see what has happened. How much of a gain in volatility on average have we experienced? And the reason why I want to do that is I can go ahead and put in my price slices on my position when I'm analyzing it and get an idea of what the potential profit is going to be. So I know when I may want to get out and when I may want to take a stop loss if it's not working out for me. Okay, because we don't want to take too much of a drawdown, even though with options, it's likely to come back if everything works out. Yeah, you may have a small drawdown at the beginning, but it shouldn't be beyond a certain amount. And we'll talk about that and how to figure it all out and manage the position right now. So again, we have the earnings here going back once again, May 6th, April 6th, nope, 5th. No, say that's fine. We had to go the 5th because it was our weekend. So that was actually a little above the average. And let's see, the gain here, 25 to 36. So 11 points of volatility. Not great, but not bad. This one, 22, spiked at 44. So we had a nice gain there, doubled basically 22. On this one, 11.8. There we go. Now it depends on when you catch this. This is actually a little bit high in volatility, so you'd want to wait for it to come back down towards the average. So right there on the 10th is about 22, went all the way up to only 29. So that was disappointing. It was only 5 on the average or 5 on the move. So we're kind of all over the place. We had one extreme, really good move. We had one very bad of only about, what was it, 5 points? But on average, if we can get maybe 15 points of volatility move by catching this at the right time, again, just keep going back. Here's another earnings release. Made a spike all the way up to what? 36. Sorry, this was on the 7th of February. It's right around, there we are, 8th, 22. Yeah, it was about 8 points. So I guess we've had a couple of extremes where it's really, really good, and then many where it was only about 8 to 10 points of volatility increase. So 31. Sorry, date was 10/26. And this one, you had to get in a little bit earlier if possible from 17. That would have been better up to 31. That was a huge, again, almost doubling. But let's say we got in 1 month before. Sorry, this is on what day? 27th. Because this was a little too high. When you're looking at volatility like that, 1 month before the earnings, I would not want to get in because we're well above the average already. So we want to catch it near or below the average. So we would have to get in back there. But let's just call it 12 points volatility on average. That's the increase that we should experience. So if we were looking currently at an option position or building an option position on this, I'm just using the at the money options, which I already selected. And here we are. We got the 155 call, 155 put. Again, we have very limited time exposure and directional exposure because we go long on both. So we go to analyze this. I think I already had it in, didn't I? And just added it a second time. All right, let's clean this up. Okay, there we go. And just do it one more time. 155. I already have the 160s anyway. And 155. Oh, did two now. Put it back. There we go. So just buying one of each. By the way, you can build this easy right here. Just clicking on the spread and choosing the right one. So we're doing straddle. And you just click on the ask to buy 155 and we put in the position. What I did was build the position singular by using just single option, opening the chain that I want, and I hold down the control key when I buy so I can do multiple legs. Okay, so now we analyze. And we, by the way, I only did one aspect of it right there. I only focused on the volatility. Right now, let's say, what do we have here till expiration? 0 days till expiration. Now 95 days left. That's what I chose. You can tell right up there. Oops. In the legend under my graph, I only need 2 days. Oh, sorry. 2 days. There we go. We have now, which I don't really care too much about. And then that's at expiration. But what I care about is, let's say the earnings are coming out in, let's see, I said 95 days currently. So I'll do this in 30 days from now. 65 days. What I was doing is adjusting this little bar here because it adjusts my chart and I can count the days till expiration right there. So since today was 95 days till expiration, we're already past the close, so it should only count for tomorrow now. But now I'm basically projecting that data point or that data on my chart, that plot number 2 is 65 days till expiration, which should be right around the earnings the earnings release day. Actually, let's say if it's 30 days, I'm going to go a day or two before because that's where I may exit. Instead of waiting for prices to move, I may want to exit when the volatility is very, very high and have a decent profit. So let's price that out. Again, I backed it up 2 days. There we go. And I'm going to change the plot to plot 2. So all these numbers are based on that exit date, which is roughly 28 days from current date. Okay. Well, you can see on this curve in my price slices, let's see, this was last price. So if nothing moves, except for time goes by, we're going to lose roughly $280. Okay. Which is obviously not something we want to have happen. And it's not likely just to stay still. As we saw, Hershey tends to move in the trend for a little while. My current, let's see, delta is, no, that's not right, is it? Oh, that's wrong. I was looking at the wrong one. My delta right here, 10. I have a bit of a positive delta, so I have a bullish bias right now, slightly bullish bias. And my Vega, 62.39. That's for this position. This is the open position I have currently up top, so don't worry about that one. And then my time decay again, only 9.23. So I've a little bit of time decay, can't do anything about that. I try to lower it as much as possible by going further out for expiration. If I want to go further to May, I'll be paying more in premium, but I look at that as a deposit. If you guys remember the old soda bottles, when you buy those, you used to take them back and get your deposit back for a few cents. That's kind of like what we're doing here. You know, time will decay, but we get our deposit back because we're buying options that won't decay very much, but they will have a lot of exposure to volatility. So now all I have to do is kind of guesstimate. Now, this is not going to be exact 100%, but let's say going back to our chart, now instead of focusing on the volatility change, which I'm going to use maybe 12 points, you know, we're not going to get gigantic moves on every single one. Sometimes it was as high as 20. Actually, I'll move it down to 10. We'll just say it's only 10 points of volatility movement. Again, I'm looking for the average movement in volatility between the time I'm looking to enter and the earnings date. or actually the peak before the earnings day. It's usually 2 or 3 days before the earnings release, because that's most likely when I can take my biggest profits based on volatility. And then, of course, if you wait, the volatility dumps, all the profits go bye-bye. And you saw that from this day to where we are now, down $900 in the two different positions. And I didn't mean to combine them that way. I don't know how I did that, but I'll split them later. Anyway, the other thing I can do now is take a look to see how much price movement on average we expect. If we're getting a trend move in the direction of the dominant trend, well, how much price movement should we expect? So this was an earnings release. Let me see, am I on 2023? That's good. So we have October 27th, September 27th, roughly. We moved from 203 to about 190. Okay. And we'll go to the right. Actually, probably do this a little faster. So about $13 of price movement. Here's another one. Again, this is guesstimating, so it's not exact, but it's what we have. Again, the 9th and the 9th. There we go. So we moved roughly from 190 in this case to about 198. So we had $8 of movement. So we had about, was it $13 of movement? Now we have about $8 of movement. This one is easier because I had it labeled. And that one really didn't move. Okay. I mean, it moved in the interim, but overall, it went nowhere. Kind of funny how that works. And this one has a big move. We went from roughly 183 to 199. So we went about 16. Yeah, we've got 11.8. Now 188, 174. So again, about 14 or so. So we can get some pretty good price moves here as well. All right. So we're looking at a little over 10% price move on average. There's one time where it went 0, but in the meantime, if we had this nice trend, and this is starting a bit of a bullish move right now, after we gapped up from earnings, you can see that we had that reversal pattern before. We had moved down, bottomed out, and then rallied sharply. I saw it back here, right here. This was a kind of a U-shaped bottom, and I thought there was another one I noticed right here. So hypothetically, we could get a potential 10-point move to the upside as well as a 10-point volatility move. So going back to our price slices and our analysis, if we take a look at, what was that? About a 5% move to the upside, 10 points, we're trading about $150. Yeah, it's less than that actually, but let's do 5% because that's what I have here as a default, or minus 5%. There we go. So we can see with price moving, unfortunately, that price movement doesn't move far enough to get us into profit. I'm focusing on the blue, by the way, not the yellow. Probably should use the yellow color for that one because it stands out better, but that's okay. So the blue chart is the value, hypothetically, a day or two before the earnings release. And it's not really doing much for me profit-wise. So what's going to be the game changer, the big difference? Let's do 5% volatility increase. And look at that. With the price and the volatility increase, that makes the difference right there. That's what I'm saying. The volatility is much more important. That's 5%. 7%. Another profit, right? Everything's in profit. Even if it doesn't, well, yeah, if it doesn't move anywhere in price, if volatility goes up by 7%, and that's still below the average price of volatility movement, right? The average volatility movement is about 10%. So if we go up by 7%, this is profitable. Not a huge amount, but it's profitable, period. And if it does move eventually by the 10%, even if prices don't go anywhere, we stand to profit theoretically about $247, even though time is decaying. That's if prices go nowhere. Interesting, if prices go up, remember I said we had a bit of a positive delta, so we're biased to the upside. So if we get that uptrend continuing, we actually make $404 theoretically. If it goes down, we still profit, not as much because we're a little bit flatter on the bottom of the curve here. Okay, so let's take this number, 247, the worst case scenario. Prices go nowhere, but our volatility increases by the average. So our possible gain would be $247 roughly. I'll call it 250 to make it easy. Well, if we profit $250, potentially divide that by $1,775, that's the cost, right? Price of the option would be $1,775 right now times 100. That's about a 14% return in 28 days. That's if prices go nowhere. Obviously, if the trend does continue to the upside, could be even higher. But I want to prepare for moderate to worst case scenario. Obviously, worst case would be if volatility didn't go anywhere, and we'll look at that in a moment. So the 14% possible gain, if I'm theoretically going to be making about $250, I really don't want to risk more than 1/3 of my potential gains. So what I could do is monitor my position. If I get a drawdown greater than 1/3, which looking at about 83, we'll round up to $85. So if we get an $85 loss in this position from entry, perhaps I just bail out of this so I can monitor that position and look for that. If we gain that $250, I could take the profits right away, or I could just wait until, again, I expect at least a 10% gain. Maybe we get lucky and it gets a bigger gain. And it has happened, obviously, because that was the average was 10%. So taking a look at the volatility jump, what happened on the last one again? From the day of entry on the 10th, we were at 163. When volatility was spiking, we were at 145. So we moved $18, in this case to the downside, not up. And I should be looking at this one for implied volatility. There it is, 10th. Oops, 26. We went all the way up to 42. That's right. So that big jump. So what do we have there? I can't think now. Was it 16? Yeah, 26 to 42. Yeah, I'll do the math. No, 26. Yeah, 16, I was right. So we had a 16% gain in volatility. So if something like that happens, look at that, much bigger gain, even if prices didn't move anywhere. But in this case, prices actually moved by $10, which was not quite 10% would be 16. So yeah, it's almost that to the downside. So it would be something like this number, 577. So much bigger profit, obviously. So I don't necessarily want to get out just because we hit a certain target profit. Obviously it could have kept going. If I got out at 250, I left a lot of money on the table and eventually it topped out at 577, right? But I should expect at least the averages. And again, if prices don't move anywhere, I'm looking at $250 of potential profit just on the volatility rising and getting out before the earnings release. So that's how I'd manage that. I would watch and see what's going on. And I would definitely focus more on the volatility, less on the price, because once again, I neutralized the delta to a certain extent. It went down to 10. I neutralized the time decay by choosing the longer term options. And I'm just playing the volatility right now. So if we want to go simple, and a lot of people start off in options just doing a long call or a long put because they want to be buying the stock or selling the stock, but they want to do it at a discount. Well, again, you can neutralize a lot of those risks that you're experiencing. So if we go out and just look at a stock, change stock now. And take two. It's popped up right there, so why not? Looks a little bullish, just had earnings, reacted pretty well to it. Don't know if that's going to continue, but hypothetically, most people look at the stock and let's see. See, this would have been a good candidate as well before the earnings. You see the big jump in price, and that one actually profited on the price. But again, look what happens with volatility. Big drop in volatility. That could actually be greater than what you'd profit on that delta. So you got to be careful. But let's just say in general, we're bullish on the stock. We're expecting it to go to the upside for a while. Many people would either buy the stock, it's $212 a share. It's kind of expensive. Do you want to buy 100 shares? Or buy a call, right? Well, if we go out and buy the call, actually, before I go there, delete the analysis. The workspace? Absolutely. I don't have to send it. You can download it right now. The workspace I'm using is right here on the Options Education Center. All the workspaces are there that I'm using. You just go to right there, Strauss Opportunities for Earnings. It's for this one on the right when you go to that page. Yeah. And when you click on it, you'll see right there, download workspace. Yep. So I helped build a lot of these workspaces. So Jesus perfects them. So I just help out a little bit there. Anyway, going back on this one, again, Strauss for earnings, got the workspace there, thinking we're just going to go bullish. Instead of just buying a call, which is what I wanted to show this one. Let's see. TTWO. Now, I've been doing options education and trading education for about 25 years or so. So I've seen a lot of the same mistakes that people make over and over and over again. And common mistakes they do is, they think, oh, well, it's going to go up. I want to buy this, but, I'm trading an option because I would like the leverage, or I don't want to spend a lot of money, or I have limited funds in my account, whatever it may be. It doesn't matter. But a mistake that a lot of people do is they just go out and they buy an option. Let's see, we're at 212 right now. So maybe you buy the 210 call because you're bullish on the stock. Let's get rid of the Hershey's there. So if you buy this option, again, you take a look at what's going on here. We got the delta, positive delta. It could go deeper in the money, get a little more delta if I wanted to. The problem is the time decay is going to hurt me. And again, I go to analysis here, and I didn't even look at volatility to see, but my exposure is at 24.34. So it's not great, but it is going to give me a little bit of a boost if volatility goes up with price also moving up with a positive delta. So if I want to help myself a little bit here, I can create a spread instead. And what all I'm doing is, this is what's called my anchor leg. The first option you choose, it kind of drives your direction and it drives your profit. That's what the anchor leg does. It sets up, are you bullish? Are you bearish? Are you buying or are you selling? The other option that you choose is called the offset leg, and it offsets these Greeks to help manage the risk. Put this back to 0. So we go back to our options here, and I chose a 210. Perhaps I decide, you know what, well, first of all, better decision would be perhaps to go a little further out. I'll do 129 days. Why not? And I forgot, what did I choose before? It was the 210. So I buy the 210, and yeah, it's going to cost a little more. But that's not what I wanted. Delete. There we go. I just wanted to compare these two. And here we have, obviously it's costing more, but that's the deposit that I'm going to get back for the time. So it's going to cost me not 800, but now 1800 to buy an option that's further time until expiration. But what I've done by doing that is increase my volatility exposure almost doubled it, right? From 24 to 49. So that's going to help me, especially if I buy in very low volatility. And I've reduced my time exposure, my theta. So I'm taking that a little bit further out of the equation just by selecting an option that expires further out. But really what I can do now, delete that one, go back, is if I know where I'm likely to sell this, I'm not going to go through all that right now. I'll just pick a hypothetical number. But if I'm willing to buy it around 210 and sell it, let's say at 280, I create a bull call spread, which is debit spread. And let's see how that looks in comparison to just simply buying the call. Well, price-wise, buying the call is 18 bucks. Now, the bull call spread is only 16.69. So what did I do? I lowered my maximum loss that I could be exposed to. I've reduced my risk by doing that. And yeah, I'm suffering a little bit on the delta, so I won't make as much. Anytime you lower risk in a position, you lower reward. They go hand in hand. You can't have one without the other. I did lower my volatility exposure a little bit, but again, I reduced my cost and my risk, and I reduced my theta, my time decay. So I neutralized my time decay and max loss with, again, neutralizing a little bit of my potential profit. But if prices are not likely to go above this before the expiration or when I wish to exit this position, this could be the smarter play to limit my risk and give me a better rate of return. Because I could get a better rate of return by the expiration. And I have to go ahead and price these all out individually to show you that right now. But those are some of the things to start thinking about when you're doing those positions. And once again, I can take a look to see in the past when prices have moved a certain amount, what has been the average volatility move, and you can price slice with volatility adjustment to get an idea of what your potential profits are going to be based on what has happened in the past. Unfortunately, I've kind of run out of time here. Jesus probably let me keep going, or at least blame it on Trent because he thought I was him.
It's
Anyway,
true. But I don't want to cut off your thought process either.
yeah,
You're in the middle like of a sentence and you stopped.
yeah, no problem.
All right, all right. Okay, well, yes, this is the end of our presentation. As I said at the very beginning, we are recording this and it'll be available on the TradeStation Options Education Center. So make sure that you go there and explore. I haven't shared, I think I talked about it, but I didn't share a link to it. Let me go ahead and get a link here very quickly from my browser. So that's the Options Education Center. It has all the articles, all the webinar recordings. It has a banner for Options Replay where you find Brandon's presentations. So make sure that you go there and explore. I don't see any other last minute questions here. So I want to appreciate everyone's time. Brandon, thank you so much for being here again. Everybody, please check out also our events calendar. We have great topics coming up. So thank you for being here today, and I'll see you next time. Goodbye, everyone.